couple of drinks to loosen himself up, and he said he didn't. So.
All right, we're recording. So today we are talking about accounting, the very, very exciting, definitely not dry chapter of accounting, using Samuel Zemurray as the historical reference today. So we will discuss who he is, but first, so our plan of attack today is similar to what we do every time. But we'll go through the briefing, explain what we're talking about, what a pro forma is, those types of things, what the battlefield looks like today, what the current banking environment looks like versus the accounting environment. Then we'll dive into Samuel Zemurray and why we chose him as our accounting person, historical figure today. Then we'll talk about the enemy mistakes, which are problems that we see a lot of entrepreneurs make with their accounting and pro formas. The strategic cheat code takes the lessons from Samuel Zemurray and applies it to your business. The debriefing is making it operational, so how we can take that cheat code and turn it into something functional for you. And then the tactical takeaways are a 3-step process where you can build your own pro forma. So the battlefield today, your pro forma serves a lot of purposes. First of all, the pro forma is basically a P&L statement that's projected out a certain number of years. A P&L statement is the profit and loss statement. So there's 3 financial statements that come in a financial docket. It's your statement of cash flows, your balance sheet, and then your P&L statement or your profit and loss statement. Most banks will be okay if you only submit the profit and loss statement. Some banks want to see the balance sheet and profit and loss statement. Very few will ask for the cash flow or the statement of cash flows. And trying to cram 4 years worth of accounting was difficult enough. So we are intentionally leaving off the balance sheet and the statement of cash flows because then it just becomes an accounting lesson. And that's not really what we're here to talk about. We're here to talk about how you can use your business plan to get funding or improve your business. So
contact your CPA or local tax advisor.
Yeah, exactly. Yeah, I can't say this enough. Even if you I had an accounting degree at one point, and I still use a CPA. So I can't stress it enough. You need to have somebody that's keeping up with the rules and regulations, especially with the accounting standard operating procedures changes all the time. Tax codes change. So you really need to have somebody who's informed, who knows how to navigate the system. So I can't stress this enough. Even if you get this chapter, you probably still need a CPA. So
in Network Action has a very good one. So we'll put a plug in for Terry Aylin as we go on.
All right. So, sorry, I didn't mean to cut you off.
No, fine.
Sure, all right. So, what the bankers will look for your profit and loss statement or your forma to kind of tell the picture or tell the story of your business only through the numbers. And I'll be honest with you, most of them will flip straight to the P&L. And it's not until they start trying to figure. I guarantee you, most bankers can't even tell you that the brand is important. But I've been in those meetings, and I know they'll eventually talk about it. It's just the numbers are what's front and center. The brand is going to help you, and it's going to help them. They don't understand that part of it, but it ends up factoring in later. So this is probably the most crucial thing when it comes to getting funding. It can make or break your business if you don't do a good job of understanding the numbers, to the point where I was working in sports, and I was getting tired of working 80 hours a week for like $30,000 a year. And I was looking to my next, I've always wanted to be an entrepreneur. And during that time, I read an article, I think it was Mark Cuban wrote it, that said the number one thing that an entrepreneur needs to do is be able to read a financial statement. So that's why we're here.
Mm-hmm.
So a typical pro forma has bare minimum 3 years worth of projections. Most will require at least 3 years and then probably year 5. And then if you're doing commercial lending, they're going to ask all the way through year 10. And they want to see the first year broken out month by month, the next 2 years broken out annually, and then year 5 and year 10. And we'll go over all that later. The other reason that we want to look at this is a lot of times people make money on paper, but cash flow doesn't quite equate to it. So I'm not going to do a whole accounting lesson here, but there's things like your loan payment that if you understand the debits and credits and the accounts those go through and T accounts and all the fancy accounting terminology, that never hits your P&L, but it is a true expense to your business. So you have to be able to understand a little bit about that to understand your true cash flow and how much you're going to take home. Otherwise, you can make some real bad decisions and leave yourself and your employees in a real bad spot.
Mm-hmm.
They typically, the bankers in particular, a lot of the venture capitalist firms will talk about EBITDA, which stands for earnings before interest, taxes, depreciation, and amortization, and your debt service coverage ratio. And we'll discuss what that means later on when we get to how to calculate them. But those are two ratios that if you don't know what they are, then you're probably not getting funding. There's no other way.
In layman's terms, the DSCR is debt to income ratio.
Yeah, they utilize that in residential lending as well.
Mm-hmm.
It's just they call it something different on the commercial side. Why? I don't know. I'm actually convinced that banking's really easy. It's just trying to understand the terminology that makes it hard. So
Mm-hmm.
then they're going to stress test your model. They're going to look at what you projected, and then they're going to create a bunch of scenarios that determine if you can survive. An economic downturn would be an example. Something that hurts your business. Do you have the margins and capability projected out to withstand that? So we've talked a little bit about we've talked a lot about the 5 C's of credit, and capacity is, do you have the capacity to actually take on a loan? And that's exactly what DSCR calculates. Can you actually afford to do that? This is kind of where things start tying together. So we talked about your marketing scheme, and this is going to be the numerical way of showing that how your marketing scheme is going to work. So if you project that your sales are going to magically increase 30%, you better be able to show on your marketing scheme how that all ties in. All right. So Samuel Zemurray, he is a very controversial character, which I think I picked all controversial characters up to this point. I originally wanted to write this chapter using a mob boss, and I had one set up for an interview, and they wouldn't do it at the end of the day.
Wow.
So mad about it. That would have been funny. But Samuel Zemurray is kind of the both the pro and the con of capitalism. And I think it's we were going back and forth a little bit earlier today about some of the fantastic things he did and some of the infamous things that he did. But his story starts off, he was from the Russian Empire, which we had to look up because that predates the USSR, the Soviet Union. He wasn't necessarily poor, but he didn't exactly come from means either. Mindy, did we look up what year this was?
It was pre-19.
1917.
Yep, 1917. Yeah, right.
Yeah, somewhere. All right. So bananas were not something that you ate every day like we do today, right? They weren't at the grocery store. They were a rarity at this time. And so they were coming up from Central and South America and being sold on the railroad track. The problem is it took a long time to get them here. And so if they brought them to the United States, I think he was in Mobile, Alabama, is what I read. And if it had a freckle on it, they knew they couldn't get it to the next stop before it went bad. So they would just discard them, just throw them away because it wasn't worth transporting at that point. And so Samuel Zemurray, he has $150 to his name, which 1920 was, a lot more than it is today.
Okay, so actually, he came over in 1891 at the age of 14.
Ah, okay. I don't know when this story takes place. I don't know how old he was, but
yeah,
I don't think it says. But either way, so they're just discarding these bananas, right? Well, he decides that he's going to take his $150 and he calculated how much he could sell each banana for. And he calculated how much he could buy train tickets for. And he found that he still had a margin if he bought the bananas for a certain price. So he would go in, he would buy all the discarded bananas, and then he would ride the railroad station all day long. And at every stop, he would sell his bananas. So he was so good at not only understanding margins, he was also an expert at strategy. And we'll talk about how that plays into his future later on. But because of that, he ends up growing this little venture that he created as, kind of a side hobby project into United Fruits, which was and still maybe is, it's gone now. It got acquired. I don't remember who bought it, but at least at the time, it was the biggest fruit distributor in the world. He lived and died by the P&L. He understood the margins. He understood how to increase profits really fast, and he beat the spoilage. So he knew how to align operations with the numbers, which is what made him so effective. He funded I don't know how to say that, Cayamel Fruit Company, which later became the United Fruit Company. But his strategy was always very bankable. So as he continued to grow, he was able to explain the margins in a way that just made sense. And he was able to sell his company, his board of directors. In fact, there's a really funny story about him fighting with his board of directors that I'll let Mendy tell.
It's just a little interesting fact that he was purchased by United Brands Company in 1970, which would eventually in 2001 became Chiquita. Crazy, huh? Wow.
Yeah.
It's crazy. You think about the brand that's still alive today, started with this dude back in 1899.
1890. So some of the things that he is infamous for was these bananas were being grown in Honduras. He had an entire banana farm in Honduras. And the workers had to stay in the field as the fields were being fertilized. And they would drop blue dye to show what was being fertilized and what wasn't. And there were workers that would volunteer to do this because Honduras was so poor at the time. And they would get, hazard pay, basically, to go work the fields during fertilization.
Hazard pay. Death pay.
Yes, exactly. Eventually, they would all die, and they knew that going into it. So, he did kill a lot of people. In fact, there was another story about him getting in a fight with J.P. Morgan. And J.P. Morgan at the time was involved in politics, House, Senate, something like that. And they were trying to stop Zemurray from doing this, and they were trying to ban exported or imported fruits. And so Zemurray goes and buys a retired Navy ship and sails it down to Honduras and tells everybody in Honduras that the U.S. is invading Honduras So there's this big clash between the people of Honduras and the U.S. government just because he wanted to continue to supply his bananas.
Yeah.
So the guy's got some bad history too. He
The
later,
strategy is insane. I mean, you
yeah, the
see
strategy is
to make money, and you make the money, and yet, I mean, there's always corruption, right? There's
yes,
always the downside of business too.
right. So fascinating book. If you want to read the book, it's The Fish That Ate the Whale. A great story about him. It does a great job of really balancing and trying to weigh out the ethical dilemmas that he had to face. And, really, he's just an interesting guy. What was this quote, Mindy?
You just want me to say it. So he attended the United Fruit board meeting, in which he produced the proxies dramatically saying, "You've been fucking up this business long enough. I'm going to straighten it out." And that's when he was moving. He was out of the Honduras coup into the Guatemalan coup.
Yep.
So
Great guy. That's what we're saying.
something like that.
We're gonna edit that. We're gonna edit that out, Mindy, so you don't have to take it.
Okay.
All right. So, enemy mistakes. These are the things that, as a banker or somebody putting together business models, working with consulting with a lot of companies, these are the things these are the mistakes that I see a lot of people make. They want to put lipstick on a pig, is I guess a way of saying it. So, people don't like talking about the weaknesses in the business plan. And they think that if they don't put it into their business plan, that nobody's going to notice.
Mm-hmm.
And it doesn't work like that. So you got to understand there's bankers that go to school just to understand how to find these pressure points, and they're more than likely going to find them. So what I see usually is they try to tell me that, they're going to start off selling 100,000 units because if they build the business, then people are just going to naturally appear. The Field of Dreams model, and it doesn't work. Like, we catch the mistakes all the time. And what's more beneficial is if you tell me what's going to happen or what could happen, and then if that does happen, how you're going to mitigate it. So we went through this with the SWOT analysis of identifying your weaknesses and then coming up with a mitigating factor. That is so much more beneficial than trying to put lipstick on a pig.
Yeah.
Mm-hmm.
And I mean, bankers understand the nature of business, right? They know there's going to be ebbs and flows. And so for us not to be real with our numbers, it only hurts us because we're not saying, here's the state of my business.
Right. And once they decide that you're not trustworthy, if you lie on your P&L statement, once they decide you're not trustworthy, they're just going to decline your loan. I mean, there is no take backsies when it comes to that. So be honest. In fact, I had a client here recently, great people. They made some bad business decisions. They took on a partner that ended up not being a good deal. This happens. I've seen this happen to some of the most experienced entrepreneurs. So it's the type of thing that happens. And they couldn't get approved for a loan. And when I went back and read through their story, it was because they didn't want to address the problem. They didn't want to tell people that they had made a mistake. And after I went, and they didn't lie about it. I want to be clear about that. They just didn't know how to explain it. But after I told the story, the bankers were a lot more sympathetic and willing to work with them. So, occasionally there is a banker that has a heart.
Mm-hmm.
Another big thing I see is top line bragging. I don't know how many people I've ran into that tell me they make $1 million a year, and they think they're so high and mighty, but they spent 1.5 million to get there. And so even though their sales look really good, their operating expenses look really bad, and it's something that gets people in a lot of trouble real fast. Cash later and bills now. So as we were talking about, there's a certain ebb and flow to every business model. Very, very few make money in the first year. Most don't even make money until year 3 to 5. And so you have to understand the true cash flow of the business, and you need to be able to show that in your P&L statement. This does get very, very complicated real quick. So it takes me weeks to figure out some of this stuff for businesses. So I would say if you're very concerned about it, to use your CPA and help you figure out a true cash flow model. But to that point, if you don't show how you're going to ramp up over time, and that your marketing plan, if your marketing plan doesn't align with your sales projections, then you're gonna show a lot of issues in your business plan. People like to copy and paste growth models. So what I see is, this year we're going to sell 100 units. Next year we're going to sell 150 units, and the year after that we're going to sell 200 units. It's like, okay, how are you going to get there? And like I said, people have this field of dream model of, well, we're just going to build it, and then people are going to start, and then the word of mouth is going to take off. It's like, that's not how businesses run. You have to be able to discuss how you're going to make that happen. If you don't have a good plan, or a plan that somebody's going to buy, then you're not going to get funding for it.
Right.
Which gets us to, do you have a statement?
No, I was just agreeing with you.
Oh, okay.
I do then to consider, like, if you were investing your own money into your business, what would you want to know? Or any business, you're going to do your due diligence before you just hand over $5,000, $10,000, $100,000, $1 million. And so this is what, we're asking you to do, is be transparent in your business.
Mm-hmm. Right.
Yep. And if your marketing, I've already said this, if your marketing plan doesn't math out, if you can't figure out how you're going to close enough business, if your cost per lead and your close rate don't match up with what your sales plan says, then you're not going to get there. And we've already gone over hide and hope. So hide things, hope nobody notices. Try to bury your problems.
Doesn't happen ever.
No, it'll come to light.
Exactly.
And if for some reason the bankers don't catch it and they do fund it, and then something bad happens later on, it's just that much worse. So, all right. So the strategic cheat codes that we can learn from Samuel Zimuri. First of all, he was fantastic at understanding his margins. That's how he went. That's how he was walking down the railroad tracks and looking at this pile of bananas and figuring out how much it would cost for him to ride the entire railroad and sell these bananas and get back. So he did it very quickly and figured out he could actually make some money, enough money to grow it into United Fruits. He was really good at putting together a strategy based on the numbers, which is how he ends up getting here. This is why he said that his board was, what was the quote?
I did it once. It's on you.
The long story that I'm not going to get into is the board was not making good financial decisions. He steps back and takes power over, and he's seeing this. Uh-oh.
Please hold.
What's going on with my computer? Oh, it came unplugged. Did I get it back?
We can hear you. Yeah.
So he was really good at creating the roadmap and presenting his investment projections. He was also really good about tracing his revenue. He could tell you how he could sell something. So it wasn't, pie in the sky of build it, they will come. He could tell you exactly how he was going to reach his customer base, when he was going to, and how the cash would continue to come in. He was also really good at understanding his break-even points. This is something that we see a lot of problems with. People don't understand how many units they have to sell in order to completely break even, to cover all their operating expenses. This is, baseline of what you need your goals to be. And a lot of it comes down to a lot of the marketing metrics, understanding your leads, closing rates, price, and your margins and costs. Then there's the cash reality issues with this. So we were discussing net 30 earlier, where if you close a contract, you're not necessarily going to get paid the time that it closes. And this is a problem that we see in a lot of P&L statements, is you have to figure out exactly when that money is going to hit your account, especially in the early lean years. And so if you're selling on like a net 30 basis, which means at the time that you invoice, your client has 30 days to pay it back, you have to understand when that payment's going to hit. Also on the P&L, we have some non-cash expenditures. So we'll talk about add backs and depreciation later. I really wish we would have had somebody on here that could give you like the true accounting explanation of depreciation. But the short answer is accounting professors love to use the example of a vehicle. So if you buy a truck for your business, let's say it's a $50,000 truck, there is an anticipated 5-year life of that truck. Yes, you can extend it, but that is irrelevant. The accountants are going to look at what the average lifespan is, and that's roughly 5 years. Then they're going to take that $50,000. So once you drive it off the lot, you've already lost a significant value of the vehicle. And then as you continue to put miles on it, you're going to continue to lose value in that vehicle. As it gets older, you lose value. So what the accountants are doing is trying to account for that loss of the value. And that's what they call depreciation. An easy way to account for depreciation is straight line depreciation, which would just take the $50,000 divided by the average lifespan, which is 5 years. So $10,000 you can write off a year. Please do not take my word on that. I'm not giving you tax advice. Cannot be more clear about that. Go talk to your CPA, because there's a lot of different ways that they can calculate it and use it to save you on taxes. And that's just one example of a very easy way that they might do it. And then last, your assumptions page. So your P&L is something that you're going to end up spending a lot of time and effort on, and I guarantee you it's going to make sense to you at the time. But you have to understand kind of the flow of how a bank is going to look at this. So a loan officer is going to meet with you, and you're probably going to have a very nice conversation. It's probably going to take an hour or two where he's going to ask you all the questions. But then you're relying on him to take good notes and pass it to the next guy, which was what I did, the credit analyst, who's going to take all of that information and put it into a report. And then that report is going to go to either the CRO or credit committee or both. And so if you've ever played that game where you line up and you whisper in each other's ears and you're not supposed to, you've got to pass the message along. What is that game called? There's a name for it. Telephone. Yes. So that's basically what you're playing if you don't put it into your business plan. So if you do a good job of explaining your numbers in your business plan, then by the time it gets to the CRO or credit committee, hopefully you've made a better argument than what the analyst and credit committee would have done otherwise.
Yeah, and that's also we've probably all of us, in a different, similar but different realm, is that we've given some great presentation to the wrong person, and what happens is the person you gave the presentation says, "I'm going to take it to the boss," or "I'm going to carry it to the boss." But by the time they take my buckets to the boss, there's a lot of holes in the bucket, so they never get the true story, and they don't get the, like you said, Rob, the correct information sometimes, because the relationship built is based on with the initial conversation.
Yeah.
So the personality.
Another analogy would be just lost in translation, right? When you're talking with international business and you have somebody translating and the words just don't line up. And so they're like, no, thank you. And you're like, we've been working on this for a year. Like, I think something happened. What happened? So a lot of lost in translation.
Right. So, debriefing. How do we make an operational pro forma? First, you want to start off with a list of all your offerings and your pricing so you can come up with your margins. You want to be able to do the math, understand what it costs for you to bring in a new lead. You need to understand how often you close on a new lead, how much it costs, or the difference between bringing in a new lead versus a new customer, and how many units you need to be able to sell. We'll go over some of this later on. You definitely need to be able to understand your year one P&L, and that would include your projected revenue, cost of goods sold, and operating expenses. You definitely need to understand your break-even point, because if you can't reach that, you're never going to make money. You need to understand how to put together an assumptions page. And the more data that you can use to support your assumptions and numbers, the better off you are. You need to understand the risks that are going to occur in your business, and every single business has one. I've been doing this 10 years, 12 years, something like that. I don't know how many deals I've underwritten and helped people put together. I've never seen a business plan that didn't have some sort of risk or some sort of what we call hair on the deal. And so if you tell the banker there's no problems with it, then they're automatically going to assume you just haven't done enough research. And once you identify the risks, then you need to tell everybody how you're going to mitigate the situation in the event that it does occur. Then you want to be able to create the story and tell somebody how you're going to make money. All right, so now diving into the fun part. This is how you can start to put together a pro forma. And like I said, as we were putting this together, it was a real hassle to try to figure out where we start, where we end. And we're kind of jumping into the middle of the accounting formula and how accounting actually works. So we're not here to have a true accounting lesson. This is just how you can take it and make it operational for you. If you don't understand accounting, or this is just way over your head, like I said, there's people who are dedicated to helping you figure this out. Stuff like the SBDC has a lot of free materials to help you get there. CPAs will typically help you do this. Even bookkeepers can help you put this together. All of those people have a background in accounting that can help. So the way that you start this is it all starts with your margins. So you have to be able to understand. Sometimes you run into businesses that have multiple streams of revenue, right? Think of a restaurant. They may have 30 menu items that all have different margins. Way overcomplicating things. So we're just trying to give you the baseline of how you can get started. So pick one of your offers, pick the price. Remember, we went over pricing when we did the strategy, right? So we came up with the range and said, based on how well you fit one of those businesses that you're comparing yourself to, you can come up with a price. Then you have to understand how much it's going to cost for you to produce whatever it is you're producing. In the manufacturing world, this is a lot easier to understand because you have raw materials that are going into it. And there's a price per raw material, where in services, it's a lot more, the tangible cost is a lot different in the way that you calculate it. So it gets tricky when we would have to break down somebody very specific to understand that, right?
But I mean, it's the idea that if you were only to sell, like, let's say you had a course, if you were to only sell 10 courses a year, that's pretty expensive, right? But in year 2, maybe you sell 100. Your cost has gone down significantly because you're reproducing what you've already created.
Right.
Well, you could have additional expenditures. Like, do you have to have new technology to be able to handle that type of bandwidth? Or, where are you posting the course? If you're hosting it on, what is it, Canvas?
Cool versus LinkedIn. Yeah.
Right. Yeah. Do they have a limit of how many you can sell? And do you have to increase the membership fees or something to be able to sell more?
Yeah.
So those are all things that you need to be able to project out. All right. Then we're just going to focus on month one. We had a long, lengthy discussion about this because sometimes it depends on how you're getting quotes. And in my experience, the majority of things are going to be quoted on a month-to-month basis. If you do get annual quotes, then you can just backtrack it by 12 months, right? Mm-hmm. But by and large, it's easier to break down monthly expenditures and grow up to a year than it is to get annual expenditures and go down.
Right.
But either way can work. This is just the way that I found works the best. You want to find all your fixed monthly costs. So fixed costs are things like rent, subscriptions, salaries, things that are going to be the same every single month. It doesn't matter how many units you produce, your rent's always going to be the same, right? Salaries, like I said, this is not commissions. Commissions are a variable cost. So this is salaries, how much you're going to pay out on a salary on a monthly basis. Remember, salaries are typically the number one expense in just about every business I've ever seen, except for some of the high-end manufacturing things. But salaries will probably be your biggest expense. And you can Google a list of typical expenses. We'll probably provide, we got a pretty decent start right here. Your advertising costs, which we talked about, could be variable. Debit and credit card fees, actually that wouldn't be, oh yeah, it is on the P&L. I'm thinking of something else. Equipment expenses, things like that will all be included in your P&L. Then you have variable costs. Variable costs will increase as you increase production or decrease, or actually, I guess I should say that it'll change based on the amount of production that you do. So commissions, if they sell more, you pay more. Packaging, you got to pay per box, right? So if you increase the number of boxes that you're sending out, you're going to have to increase the number of boxes that you buy. And then raw materials, if you're somebody who's manufacturing, every single unit's going to have a certain amount of raw materials. So as you produce more, your raw materials are going to go up. Then you'll have the 5 basic, and once you get into true accounting, this can change. Look at your tax returns on your Schedule C. There's all sorts of buckets, but the 5 basic buckets that you're going to want to focus on for a pro forma is your income, which is the amount of sales that you're going to produce. Then you should have cost of goods sold in here. In this one, they've probably included it in their business income, but your cost of goods sold, which we discussed whether or not we need to break down what's included in the cost of goods sold. I promise you, if you do a good job of at least putting those things that should be cost of goods sold into your regular business expenses, a CPA can help you straighten out whatever's left. So I wouldn't focus too much on the difference between a cost of goods sold expense and a typical business expense. Then you'll have your regular operating expenses. Oh, let me take a step back. Your income, the number of sales that you produce, subtract out your cost of goods sold, gets you your total income. Then you're going to have your regular business expenses, which are the expenses we were just talking about. All of those added up together will be your operating expenses. And then you will take your total income and subtract out your total operating expenses, and you'll get your profit and loss. So earlier we talked about don't hype up your above the line without focusing on your below the line. And that's exactly what we're talking about here is people will tell me they make $1 million. And what they're really saying is their top of the line is $1 million. But when they add everything up, they have spent 1.5 million in operating expenses, meaning they're actually losing $500 or $500,000.
Mm-hmm.
All right. So once you've figured that out, then you want to find your break-even points. The way you find your break-even points is taking your fixed plus variable costs, or we call that the sum of that is your operating expenses, and divide that by your unit margin. So how much can you sell a unit for, and how much can you sell a unit for? Subtract out the expense of that unit. How much does it cost to produce that unit? And then you have your unit margin. So how much do you make per unit that you sell? So you want to take your operating expenses divided by your unit margins to find your break-even point. That'll tell you how many you have to sell to reach just a break-even.
Mm-hmm. Mm-hmm.
I feel like that was confusing, but
No, I was pretty. I followed. I followed along, so it was pretty good.
all right. Then assumptions. You want to go line by line and explain how you got to that number. Eventually, if you do this long enough, actually, I'm not even going to go there. I'll just there's certain assumptions you can leave off, but for this, I would tell you just to put everything on there. So if you're talking about your business income, okay, how did you get there? How many units did you actually have to sell? What was your price point? What's the seasonality that you're going to see over the? Well, I guess we're doing 1 month, so we won't talk about seasonality yet. But how did you arrive at the overall sales number? Then for each one, you want to talk about how you got there. So if you have a marketing budget, why is your marketing budget where it's at? Are you paying somebody to do your marketing? Are you increasing or decreasing marketing over an extended period of time? Credit card fees, they'll want to know, and this will come up in a different thing. They'll actually ask for a debt schedule, which should really cover that. So I was going to say you could leave that off your assumptions, but I just said we need to do all of them. So talk about how much you owe on your balances, what the interest rate is, what your payoff is, those types of things that would be included in that. And your equipment lease, what type of equipment are you leasing? How much does that normally cost? Insurance, you can just tack on your insurance quote or whatever. So on and so forth. I'm not going to go through all of them, but hopefully that paints a picture of what types of things you need to include in your assumptions. So in this, we did month 1. Now, for the first time, we're going to do intermediate 2 because it got way too confusing to add this, just to do this in 3 steps. So once you have month 1 done, then you want to take that and extrapolate it over the next 12 months. If you're good at Excel, this is pretty easy to do. You just copy and paste out the 12 months. And then you can go back and start adjusting the expenses that'll change. So this is where you want to start shaping your P&L for seasonality. So in industries, you'll typically have ebbs and flows throughout the year. If you're in retail, it's reasonable to assume that you're going to have an increase in sales in like November, December, maybe January. Mindy, you had a pretty interesting story about a company that you worked for and their ebbs and flows, I think during COVID.
Yeah. So, when I was working with K&N Engineering, and at that time in 2020, 2021, government was passing out checks. And so K&N is a oil and air filtration company. And so at that time, the people that were loyal fans of the brand they had plenty of time at home to do their own car installations, whether, I think, Rob, you mentioned DDI. So whether that was car audio, whether that was, installing a new intake system to gain horsepower, whatever. They had a lot of money just to go do whatever they wanted. But, in 2022 and 2023 came around, like, the government wasn't passing out the checks and people had to go back to work. And so the sales projections, for whatever reason, they didn't make those adjustments. They just kept them like people had, like it was COVID, and it was like, no, like those numbers aren't real. Like somebody made an adjustment. But it was crazy that they didn't.
I will say with Stretch Lab, we had kind of an interesting seasonal sales where everybody goes back to the gym in January, right?
Mm-hmm.
Well, then they would get hurt in February. And so we would actually see the ramp up hit in like February, March, April. And then when the summer came around, we'd see a big dive again. So you have to understand your customer when they're buying. CPAs will see a big increase in April, May, June, right? So
yeah.
It just has to do with the industry, understanding when people are going to be looking. Real estate, for example, everything shuts down after Thanksgiving. So if you're projecting your sales to increase in December and January, I automatically know that's incorrect, because you're definitely, there's a situation where maybe you close a big deal or something in there, but by and large, you're not closing anything in December. So you need to account for that. All right. Another thing is one-time expenses. So one of the best examples is real estate. Capital expenditures in real estate. If you're investing in a rental home, eventually you're going to have to replace the AC unit, right? That's a huge expense, minimum of 10 grand, I think is the cheapest I've seen it. But you shouldn't have to touch it again for 10, 15 years after that, hopefully. So that would be considered a one-time expense, something that you have to replace once, and then you don't have to see it again for a very long time. So what the banks and venture capitalists and things like that are looking for is your true cash flow. And so a one-time expense actually offsets that, and you can add it back. So once you have your operating expenses and then your total profit and loss statement, the next line would be your add backs. And for everything that you put in there, you need to be able to explain it in your assumptions. But it would be all of those one-time expenses. It would be, we had to replace the AC unit, or we had to buy a new piece of equipment, or we had to buy XYZ. So it shouldn't be included in our overall expenditures if you're trying to understand a true cash flow model. Okay, so we've taken month one and we've spread it across all 12 months. I think I can actually build something out on this if you want to take the time to do that. Oops. We'll come back to that. And then you want to make sure that your revenue, cost of goods sold, gross income, your operating expenses, and your net expenses are still calculating the same way, because we do want to be able to see the totals from month to month. Eventually, I don't care what industry you're in, you're probably going to have some months where you're lighter and leaner than others, right? Just from the seasonality of things. So a banker is going to want to know how you're going to keep up with operations in those lean times.
Mm-hmm.
Then we're going to continue to do the assumptions. And then at the end of year one, you want to sum all of the months up so you have an annual P&L statement. All right, intermediate 2. So now we've completed month 1 and year 1. now we're just going to take basically the same thing we did for year one and do it the same thing for year 2 and 3. I find it easier to just do 36 months as opposed to try to break it down annually and do year over year, because you can still work in the ebbs and flows. You can calculate, if your production increases a certain amount, then you're going to have to hire more people, or you're going to have to invest in your operations, or whatever that looks like. So if you break it down by month, at least over the first 36 months, then you can start figuring out where you need to include those new expenditures. Mm-hmm. And there's certain drivers for each one. So we talked about increasing year over year the number of units that you're going to sell based off the number of production that you make. So a typical ramp up period is usually three years, right? Usually by year 3, you're at least at full operating capacity. So how many units is it going to take you to get to full operating capacity? Price should change eventually. So most people will account for inflation. Most people are going to look to increase your prices, 1 to 2% year over year, trying to keep up with inflation. I've seen so many different thoughts about that. Some will do like a big increase every 3 years or something. I don't know what the right or wrong answer is. That's for some marketing person to figure out. But you are going to want to increase your price, which would change everything. Your cost of goods sold, if you are working with raw materials, there's a lot of fluctuation in pricing. So, how are raw materials going to go up and down? Labor costs, if you have labor that's directly working on the production of the product, that would go into cost of goods sold. So how are you going to keep up with the ever increasing salaries that we're seeing today? And then operating expenses, usually things like your lease agreement will have bumps in it. So every year your rent will increase. So a banker is going to want to see how that projects out over the next 3 years. Seasonality is one thing that you want to continue to showcase. So is it something where you're going to have the same seasonality year over year? Hopefully you do, because then you can account for it. I
think something to consider, though, a little bit in the seasonality. If you are in the service industry and you're looking at having more speaking engagements, right, in the upcoming year, in a certain, maybe that speaking engagement window for you is, I don't know, March to June. Well, there's a significant difference in how you're going to plan for promoting your business, because hopefully based off of your speaking engagements, you're going to get more people coming in, right? Mm-hmm. So you're going to see an increase in sales. Whereas if you're selling a widget that, really it's prime time from spring break until August when people go back to school, like significantly different.
Exactly.
Yep. Yeah, just another comment too, I think, because when you mentioned service folks, Mindy, that even though Rob's laying out a lot of detail here, you can still do the same thing. You just wouldn't have all those field areas filled out. Say if you're a service industry and you're looking at you're leasing now currently, and you want to go to a bank and have own your own building to do your services out. I mean, there's a lot of application, but Rob's giving you basically the detail, but it is very applicable to us as individuals as well.
Yeah, it's easier to discuss this stuff on like a manufacturing basis because mm-hmm. it's tangible.
Right.
That's why I keep going back to manufacturing stuff, but you still have the same expenses on a service. It's just you have to, I don't know, change definition, change mindset maybe. I don't know. So you'll have very similar expenses, I promise. Mindy, we were talking earlier about being a solopreneur working from home.
Mhm.
And then I think you said you went, I've done this too, where you go to your CPA to do your taxes and they're like, okay, well, what was the utility cost on your house? Like, oh,
Yeah.
I don't
Well,
know.
I mean, it was crazy. So after when I went into business working from my home, like they were like, okay, track all your utilities. We need the purchase price of your house. We need the square footage of where your office is located. You might consider including the bathroom and the kitchen because that would be like, there would be a restroom at your place of business if you were in an office. There would be a or a break room area. And so consider all of that. So it was like, okay, I had gas, I had electric and water and trash. I mean, and I was like, can I throw my house cleaner in here too? I mean, maybe.
Well, you put a portion of that. I mean, that cleaning that area, a portion of that, obviously.
Yeah. So,
You would have cleaning services at a building if you were operating out of it, right?
Exactly. So it was like they help you kind of, your CPA is going to help you kind of consider all of those areas, when you're working out of your home versus if you are in an office space.
Mm-hmm.
And to that point, again, I am not giving tax advice. I am not qualified to give tax advice. So I'm not doing that, I promise.
Yeah, me neither.
But the reason some of these things are so important is because you can use it as tax write-offs, so you don't have to pay as much tax later on. And to tie it back to the processes and procedures, a lot of those some of those processes need to include how you account for that. So if you are somebody that drives a lot, how are you keeping track of your mileage? How are you saving the receipts for when you get your oil changed? I think I told you I worked with some jackass that put all of his receipts under R because he thought it was funny.
Not funny.
It was not funny at all, and he didn't understand why I was pissed.
Our bookkeeper and our financial people in this group are probably like, oh.
Well, there's one thing I would like. I hope we probably should turn the recording off. But when I go back to Maine to visit my kids and family, I also have clients in Maine as well. And I have several clients I do video work with, so I make a point to go visit them as well. So so basically my expenses when I go back to visit is tied into, and that's the beauty of having businesses where we can work remotely. Same thing with you, Mindy. Same with Rob. If you had to go to Texas, Rob, or Mindy, if you had to go to North Carolina, that's covered as part of, and you're very smart if you can mix, like I'm fortunate to be able to mix pleasure with business. So,
yeah, agreed.
Yep. So if you want to travel, make sure you find a client.
Make sure you have a business.
All right. So keeping track of your expenses, even if you don't think that you can account for utilities, you probably still can if you're working from home. Oh, real events. Layer in, I think that's where we're at. Layer in real events. So like we mentioned this earlier, to continue to grow, you're going to increase certain expenses. Or as you said, maybe the expenses go down as you continue, like you increase bulk. Maybe now you reach the point where you can buy packaging
new products, new products, new services.
Right.
That would be layering your real events, growing your business.
Exactly. You take on 100 clients. Now you can't service all of them by yourself. So you have to hire somebody or you have to bring in a new software. So think through the operations of those. And once again, going back to the last lesson, the standard operating procedures will help you understand where those things will start coming in. Then you want to recalculate your monthly P&L totals, update. So what we've done is we've taken the 12 months that we created initially, and we've just extended it out to 36 months and then made our hopefully small, or in the case of sales, large additions to what it would look like in years 2 and 3. So then you want to go back and make sure all of your totals are still updating. You still want to see an annual year 1, an annual year 2, and an annual year 3. And then go back and you want to explain the significant jumps in those line items. So sales jumps 30%. They want to see why you think it's going to jump 30%. That's actually a very common one that we see is there's no explanation of how sales continue to increase. And just word of mouth marketing is not an adequate explanation.
Yeah. Well, and I think too, when I think about my husband's business being in oil and gas, I mean, there is significant changes for the people that they service and their clients with in an election year, right? And so depending upon what the state of the union or the state of the state is, for where you kind of focus your energy and your business, I mean, you could see complete shifts based off of what things are happening at the state level and national level. And then if you do international, definitely those things come into play as well. Rob, you're on mute. Rob,
I came in mumbling. But that was a good point, though. I think you're absolutely right, Mindy, because you have to really be cognitive of what's happening, trending in your industries currently. I mean, it's like I said before. I mean, I'll tell this again, but Rob's getting back off mute. Is that if you would take an hour a day and study about the occupation you're in, if you're in oil and gas, banking, you took an hour a day to study the role that you play in that company, whether it be CEO or you have another function, sales, learn as much as you can about the role. And thirdly, self-improvement, in motivating yourself or what encourage you to become better. If you were to do just those 3 things, your industry, your role, and you personally, you'd be in the top 5% of the people that do that. So it just goes to show. And that's what we're kind of, we want to help people with network and action. But you're right, you got to stay abreast of what's happening, what's trending. Like we talked about the other day with what was happening with the tariffs, how tariffs affect some of your clients' businesses. I mean,
yeah.
You with us, Rob?
No, I'm good.
Good. Well, we did a little filler time again, so.
All right, so now you've got 3 years of financial statements, or your P&L, or pro forma, or projections, whatever you want to call it. So how do you take this to the next level and make it something worth calculating? So EBITDA stands for earnings before interest, taxes, depreciation, and amortization. I don't want to get into what amortization, that is way beyond the scope of this. Basically, it's depreciation, but for other things, right? Yeah. Taxes are something that you definitely want to get help in calculating. You can probably calculate things like sales tax and income tax on your own, but there are additional taxes. We're in Oklahoma, so we have state tax, and then there's national tax. Get a CPA to help you understand that. And then the interest is the interest that you pay on your loan. But all of those are, depreciation is a non-cash expense. Taxes you do pay, but most companies will get a lot of that back. And then interest is a bank's taking that out because they want to see what your true operations on a cash level are. So you can either figure out if you're going to include or increase your loan amount or decrease, whatever. So EBITDA is something that it doesn't matter if I'm talking to venture capitalists, bankers, potential partners. Almost everybody quotes things in EBITDA instead of just basic profit and loss.
Yeah, in the corporate world, that's a big thing. Because they're always trying to present money to the stakeholders, which are their investors. So, when I had my quarterly or my monthly meetings, EBITDA was always the top of the top line.
Then your adjusted cash flow is EBITDA plus those one-time expenses that we talked about. You're going to add those two things together because those one-time. So you're really trying to get to a true. How much does it cost you to operate on a monthly basis, barring any type of capital expenditures? Then we have a typo on here because next we're going to talk about DSCR, which is debt service coverage ratio, or in the residential real estate, we would call this debt to income ratio. They're just taking your EBITDA, or the amount of money that you make, and they're dividing it by the annual debt service, which is the annual amount that you will pay towards a loan. And that would give you your DSCR, which most banks want between like 2 and 2.5 times. So you want to make about 2 times more than the annual debt service of your loan. Debt to income ratio, it's been a really long time since I've done a mortgage, but I think it's like 80% or something. So, and then on the marketing side, some of the big things that people look at, and this is where you're going to start doing the term that we've used is begin with the end in mind, from Stephen Covey, 7 Habits of Highly Effective People. But you want to set your targets. So this should include how much you want to pay yourself. That's another common thing that I see a lot of entrepreneurs mess up, is they don't include a salary for themselves. That is one thing. As a banker, I would send it back to you and say, no, you can't survive off that. So we did take into account your personal expenditures and your personal business, or your personal financial situation when we were looking at these, because we know if somebody is not making enough money or they're running short, they're going to sacrifice their business for their personal life. That's a whole nother thing. I used to include that.
We've actually talked to a potential client we both work with, we know well, that aren't taking salaries and they're just putting anything back into their company at their own detriment, and I think that, even we look at the big brand shows like Shark Tank, they won't talk that. You look at majority of the people that even have $2 or $3 million companies, if they're not taking a salary out themselves, they very rarely do they touch them.
Yep. So then we're going to take how much you want to make plus your operating expenses and how much you want to make to put back for the company. So I'm sure there's a rule of thumb somewhere out there. I just don't know it. But what your target revenue or what your goal revenue is. And then you can divide by the average number of sale, or that's not right. You take your target revenue and divide by your margins, and you get the number of sales that you have to produce, or the number of customers that you need.
Right. Even if you have a big margin, but it costs you a lot to get to that, your net's going to be a lot less, obviously, because because it's going to cost you more to hit those margins. You know what I'm saying? Like you like I said, I tell you what I make. You guys know what I make per margin, but I don't tell you how much it costs me. Actually, cost per lead and all the other stuff to get those leads I need to make that margin.
Actually, it is right. So what this is saying actually is you take your target revenue divided by your average ticket price. So how much does a sale typically mean for you? And then that tells you how many customers that you need to close to reach your goals.
Right.
Then you need to figure out your marketing metrics, which you have cost per lead, you have
conversion rate.
You have your close rate, conversion rate, which basically means, okay, if you bring in X amount of customers, X amount of leads, how many of those leads are actually going to become customers? And that's very industry specific. So there are materials out there that have metrics for how much you can assume you're going to make. I know when I was in sports ticket sales, because we kept these metrics on a daily basis, if I made 100 phone calls, I probably only talked to about 10 people, and I'd probably only close one out of those 10.
Mm-hmm.
So it's a 1% close rate. 10% is a probably standard rule of thumb across industries, but if you get into high level sales that are big ticket items, I think your close rate goes up. It's just the amount of people that you can sell to are very limited. So
right.
It's very industry specific. So the Chat GPT is actually not a bad resource for that. It's not always accurate, and there's things that you can do to improve your close rate. There's things you can do to increase the number of leads or quality of leads. So it's all relative to how much time and effort you put into it. But there are industry assumptions, I guess, is the best way to put it.
Right.
So you have your cost per lead, you have your conversion rate, then you'll have your cost per acquisition, which is, okay, what was your marketing budget and how much did you make off that would be your, or no, that's not right. It's the, I'm fumbling through this now. Should have kept that. I can't see my notes again, so I'm losing it. But it's how much it costs you to close a new client. And then you can use all of that to calculate your marketing budget, which is the number of leads you need to have multiplied by the cost per lead.
Mm-hmm.
And that'll show you how much you need to put into your marketing budget to reach your goals.
Which the bank, I assume, is pretty interested in that number.
Yeah, like I said, they couldn't tell you how to put together a marketing scheme. They couldn't even tell you that marketing was that important. If you really want to piss off a banker, tell him he's in sales, which he is in sales, but he's never going to admit to that. Yeah. But they are going to look at your marketing plan and decide whether or not you can actually reach your goals.
Yeah.
Mm-hmm.
All right. So I think that's finally the end of this one. I hope everybody's not asleep and you at least got something. Do what?
And thoroughly confused.
Yeah, right. So a lot of these metrics, they get really convoluted. The best advice I have is don't let it get overwhelming. Take a step back, call on some help. There's a lot of good resources out there. It's easier to work from existing data. And if you have accounting software, there's even free accounting software out there now. I used to use, see if I can find it. It's really good.
I think a lot of bookkeepers use QuickBooks. Or most of the ones that I talk to.
Really expensive, and because there's so many tools built into it that you're probably never going to use unless you're big. Yeah. Gosh, I wish I could remember that one that I was using.
You need a bookkeeper and a tax administrator.
Yeah. I was using Wave Financial, and it was free. Right. I think it was given to me by my CPA, and that's why it was free. Mm-hmm. Like he referred me, So, but it did. I could do everything in that I could because I used QuickBooks before. Mm-hmm. So I could do everything in Wave that I was using QuickBooks for. Because
Wave Financial's got. I just pulled it up. They've got a starter plan that costs $0. Maybe you're on that. Then if you did the Pro plan, which really isn't that pricey, only $190 per year, which isn't that bad.
That's really not bad. QuickBooks is significantly more.
Yeah. Yeah.
If you told me it was $100 a month, I wouldn't be surprised. So.
Yeah. And I just want to, put a bow on this, but here again, guys, I know a lot of it may not be applicable to a lot of us, and we're sole entrepreneurs, but some of the people you work with may need this. I mean, I think it's always to be intuitive to listening to our customers, our clients, and just because we're not accountants or bookkeepers, we all know people and work with people. And I think in network connection and, through Rob and Mindy as coaches and counselors, basically, that we're trying to give you the tools, not only to service you, but also to service your clients, the people you work with. So here again, if it's, and I'm not an accounting guy, but we do have people in our group and other people that we know outside of the group potentially, that we would refer you to if you're struggling with these issues. So, thank you again, Rob and Mindy, for your time, and I appreciate what you're doing for Network Connection. So.
Well, I think you're probably right. Not everybody has to be an accounting person. Not everybody has to know how to put this together, but I would argue that everybody has to know how to read this and understand where the numbers are coming from.
Yeah.
Because
where the money's going. I mean,
right.
Period. Where is the money going? Everyone needs to know that is a business owner.
And that boils into that's how you make good, educated decisions for your business.
Yeah.
So.
Yeah. And like I said, I mean, as we go, even this is kind of specific for getting funding at the end of the day, it's just getting us think about, as we talk about the various elements, it really gives us, the ones that want to, and obviously a lot of people don't, but it gives us a chance to say, hey, wait a minute, if I just, I'm sitting here thinking, if I just did tweak a couple of things I'm doing, how much further ahead would I be, as opposed to continually be on the horizontal all the time, and just, rather, as opposed to really working some verticals.
Yeah, and I get your point about, not everybody wants to get funding, but these people are trained to identify what a strong business looks like.
Mm-hmm.
So even if your goal is not to get funding, you still should strive to have a strong business.
Exactly. So. Exactly. All right, guys.
All right. Thanks for bearing through that.
Yeah, I mean, it's the unglamorous side of business, right? Because a lot of us aren't the accountants. We're not tax people. And so we went into business to provide a solution, whether that's a product or a service. And we know that thing and we know it really well. We don't necessarily know the accounting side, and we're not. I'm going to say I'm definitely not keeping my ear or my nose to the grindstone on what changes, because there are changes annually, if not quarterly at times.
What's that? There's always a saying like, X amount of businesses close every year after, 2 or 3 years of operations. Mm-hmm. I would be willing to bet money. I don't have the data to prove this, but I would be willing to bet money the majority of those, if they did a better job of keeping track of their numbers, they either wouldn't have opened the business at all, or they would have survived at least a little bit longer. There's too many variables to account for in some of that, but a lot of the failed businesses I talk to fail because they don't know how to keep their numbers straight.
Yeah. And I think Mindy, I think you had a good point where staying on top of your field, your industry, knowing where it stands currently. But I think the real opportunity for leaders and entrepreneurs is kind of be visionary, thinking historically how trends get started. Like we all know, for example, AI is going to play a major impact within our businesses. How are we adapting it? Cryptocurrency is going to be a major player in the coming years in business. So and I know there's a big broad brush trends, but in every industry there's something happening that if you're intuitive to it, you may be ahead of the curve by just seeking that out.
Yeah.
Not to say you won't be duplicated and copied, but you could be ahead of the curve. So, well, thank you guys. See you Thursday. See you in the next filming.
All right.
Good night, guys.